Hello and welcome to the Fintech Finance Virtual Arena. I'm your host, Doug McKenzie, and on today's episode, we're going to be looking at digital first banks and asking, is the tech actually killing the product? Are we applying the tech without actually understanding the needs of the customer? And joining me today, I have three guests that are really quite at the heart of tackling this question. First up, we actually have Brett King, who is an Amazon bestseller author and the host of the Breaking Banks and Futurists podcast. Brett, how are you doing here today?
I'm doing really well. Thanks. I'm glad to be joining you guys.
Well, it's absolutely our pleasure to have you on. And I guess really for our audience who might not be aware, if you could tell us a bit more about Breaking Banks and what you've been working on recently.
Sure. Actually, we just had a really interesting, we did a special high value production episode on the ECNY, China's central bank digital currency. So that's an hour long episode. We did interviews on the street of people that are, using the wallets and stuff. It's a very interesting episode if you want to check it out. And I just launched also a new podcast called The Futurists, where we interview sort of top future thinkers and thought leaders from around the world that are sort of trying to build the future for tomorrow. So there's a couple of things, Doug, that I'm doing right now.
Amazing. Well, I'm glad to have you on because it sounds like you guys are moving and shaking. And now also joining us, we actually have some FFVA regulars. We've got Matthew Williamson and Ruby Walia from Mobiquity. Guys, thank you so much for joining. Matt, how are you doing?
I'm very well, thanks. Really good. I'm looking forward to today's session with Brett and Ruby. It's the first time we've all been together, so it should be fun.
So, Matt, for our audience who might not be aware, could you tell us a bit more about what Mobiquity are working on currently?
Yeah, absolutely. So, as everyone knows, Mobiquity is a digital consultancy. We're catering to financial services. At the moment, the big interesting elements are ESG, financial inclusion, and obviously, the elephant in the room currently is metaverse. Everyone's talking about metaverse and Web 3.0, and there's a lot of people claiming they know what's going to happen. We're more looking at the exploratory events of what could happen, what's the art of the possible in the future, and potential near-time use cases.
Yeah, I think that when you actually start digging into the use cases, that is when the really exciting, the juicy moments come out of it, even if we do love to talk about the tech behind it. Also joining us here today is Ruby Walia from Mobiquity. Ruby, how are you doing here today?
I'm great. Looking forward to this fantastic topic and panel that we've got. So this is going to be a great conversation. Thank you.
Yeah, it's going to be absolutely exciting. And Ruby, for our audience who might not be aware, could you tell us a bit more about yourself and your role at Mobiquity, please?
Yes, so I've spent a number of years in Fortune 500 companies leading digital and technology transformation teams. I spent time at TD Bank and then most recently at HSBC, where I was the Chief Digital Officer for North America, dealing with lots of transformation. And I'm now with Mobiquity as a senior advisor, helping them navigate this changing landscape of financial services.
Absolutely incredible. Well, with that in mind, thank you so much, Ruby, for joining, because I think this topic is going to be, we're going to need someone that has that knowledge of the fintech scene, but also the incumbent scene, because they're really coming together. So thank you so much for joining us here today. Now, to kick things off, Matt, I really want to come to you and find out why some of the big tech players are starting to look at buying these startups, because I think it's lit a fire under the traditional institutions. Am I correct?
Yeah, so we're seeing actually that a lot of groups are suddenly realizing that this isn't all talk. What was once before the flight of the fantasy, and there'll be some really cool fintechs coming along. Suddenly we're seeing the rationalization and the entry of the big boys and girls. So if we look at JP Morgan, I think, they've recently announced the metaverse entrance, the Onyx Lounge, launching Decentraland, and actually they now have a head of crypto, and I'm just looking this up, head of crypto in the metaverse, Christine Moy. So you're seeing this more and more where the groups are suddenly not just saying, we have no interest in this, it's not real, it's for cool kids in the corner. Suddenly we have to get involved, we have to have a position on this.
Yeah.
And you're going to see more and more significant hires. I think the question is really going to be, what are they going to do with this? Are they token hires, or are they going to partner with people who are really investing in this heavily and looking to make a difference in the metaverse, Web 3.0, or just making a general difference to the consumers' outcomes, desires, experiences, etc.?
Yeah, and I think that's such an interesting thing. Is it just going to be the cool kids on the corner, or are we actually going to get some of those use cases? And Brett, if I could come to you next as well, and kind of see what the merit is for both sides. You know, why are the big banks looking at these tech partnerships, and the other way around?
Well, you know, if you look at the trajectory, 2017 was the year where mobile wallets overtook plastic cards in terms of day-to-day payments. Most people don't realize that, but the trajectory is that we'll be using mobile wallets for, you know, not just for e-commerce, but for our day-to-day banking, you know, provision. So the tech giants need, you know, their operating systems are the frameworks that will run these wallets, but these mobile wallets will also exist in the cloud and be a bridge between the physical worlds and the digital worlds, such as the metaverse. And of course, during the pandemic, use of these features accelerated. So the trajectory is very clear. Mobile wallets are going to dominate, and you have to be playing in that space. And the easiest way to do that is to partner with the tech giants that own that part of the OS where the mobile wallet is integrated. Andreessen says every company is going to be a fintech, to illustrate that, you've got also the super apps. Let's take GoTo in Indonesia, previously known as Gojek. They acquired a bank a couple of years ago for the purpose of building this fintech capability into their super apps. And so as you get this sort of coalescing of e-commerce and m-commerce capability going into apps, or Apple trying to build their ecosystem, for example, or Amazon trying to do that, or Alibaba and Alipay trying to do that, you get these two sort of worlds of the tech giants and fintech coming together.
Yeah. Now, with that in mind, coming together, then Ruby, I think we need to kind of address one of the big plays that some of the traditional institutions have been doing, and that's kind of creating these digital pure play banks, these speedboat banks. For another backdrop to kind of set the scene of this conversation, what has maybe caused these financial institutions to actually start creating these new banks without their quite historical branding?
Yeah, so I think the banks felt that they were at risk. They saw all these new competitors coming into the marketplace, non-traditional competitors. And when you look at the assets that they brought to the table, the large technology organizations in particular, one of their core capabilities was technology. They're really good at it because that's their stock and trade. But they also are really good at building, launching, and marketing consumer-facing products in scale. And so, look at how well Apple does that every year with a new iPhone launch, right?
Yeah.
And so when the traditional banks look at these big technology players, and they're very well capitalized, bringing all these assets to the table, and they clearly have an interest that in getting into financial services, when you put all that together, the banks rightfully came to the conclusion that actually there were going to be lots of competitive pressure in the future. And the best way that they could guard their position was to go digital and to start doing the kinds of things that the big technology companies were doing. Plus, there's also the simple fact that customers have changed their lives and they're increasingly using digital conveniences in their everyday lives. And so to continue to serve customers and meet their expectations, they really didn't have a choice. They had to introduce more and more digital capabilities, and sometimes packaging that up into a separate app rather than, or creating a separate brand around it rather than continuing to do it within their traditional brand made a lot of sense, because it gave them the ability to experiment in an agile way in a sandbox-like environment that didn't affect their core brand and value prop.
Yeah.
Let's also, I guess, understand that the competitive landscape is very different from a few years ago. We have a number of fintech banks that are now the largest banks in their respective markets or on track for that. So Nubank is the largest bank in Latin America with a $50 million market cap, beating out Itaú, which is at 39 billion. And you've got WeBank in China with 240 million customers. Rakuten in Japan, and N26 just now overtook Commerce Bank in Germany as the second largest bank in the market. And analysts are now starting to talk about things like market capitalization and digital customer acquisition cost as measures of the sector instead of asset size and return on equity and those things that we normally used to talk about when we look at banks. And so the rules have changed. The fastest growing FIs in the world are, those organizations that can digitally scale. So if you wanted to compete in that space, you've really only got two choices: either turn the ship or drop the speedboat in the water. And, for organizations like JP Morgan, going into the UK market, it doesn't really make sense to go in and acquire a branch network, which it would have been the strategy in the 80s or 90s. Yeah. It makes more sense to drop a speedboat in the water, a digital pure play, and try and do what the fintech banks have been already doing.
Yeah. And it's interesting, it's the way that you guys are talking about how the consumers have changed their viewpoints. It seems very much customer driven. I think I read from some research from Plaid that here in the UK, fintech adoption went from about 60% before pandemic to in 2022, 86% of people used a fintech application in their lives. So there's obviously a public thirst for it. And Matt, I'd also love to get your perspective as well, because I know a lot of work that Mobiquity do in this perspective, kind of just seeing the kind of machinations behind this decision to, as Brett brought up, drop a speedboat in the water that can just take off without any kind of runway.
I think what's really interesting is you've just seen that the IMF have announced that they're concerned and they want to look at regulation around this, about how quickly these things are growing. Is it scale? Is it truly scalable? Is it safe? And then really interestingly, actually, is it making risk for traditional banking suppliers? Yeah. Which is a really interesting perspective. It makes you think, did the regulators come up with that, or have the banks realized they're in trouble? Pressure on the regulators to say, you need to help us, because when I worked in a bank, if I'm really honest, a lot of the times the banks were constrained by regulation who kind of missed the boat. And then, it's a slap on the wrist, and then you had to demonstrate a large tech spend to show you're fixing the problem, as opposed to letting you, one, show you're fixing the problem, but two, invest in innovation and other things. So there's an element where I have some sympathy for the bigger banks, because they are tied up in regulation, legacy tech, etc. But to Brett's point, you then have to make this key decision to say, if the game has changed, but we continue to play it the way the game used to be played, then we're going to lose out. Do we rip it all up and start again? And what's interesting is, if you look at a challenger neobank or a digital mindset, you will actually build something knowing that this may only last for 2 years. Let's just use arbitrary numbers. We're going to spend $10 million to do this for 2 years, and then we're going to throw it out the window and probably spend $100 million to get to the next level. Yeah. No problem. You take that level of thought process into a bank, it's, what do you mean you're going to spend $10 million and it's obsolete in 2 years' time? It's not the same gameplay. So unless we see a change in digital thought leadership internally in the banks, they are going to struggle. And we saw, 3-4 years ago, the speedboat Bo in the UK with RBS. That was really a fantastic proposition. I was working for a company called Form3 at the time, which is cloud infrastructure payments, so cloud-based payments infrastructure. And we were going to connect them up to the faster payments network in the UK. We were ready to go. And then literally we got an email saying, we're done. We don't exist anymore. We've all been canned. And that came from RBS and NatWest themselves. So again, you can launch a speedboat, but you've got to have the appetite to understand this is a different journey, and to use the speedboat mechanism, it could be very bumpy and the waters could be rough, but you've got to think way ahead to make sure you get to shore.
Yeah, I'm loving all these boat anecdotes, guys. It's metaphor, sorry. Sorry, Brett.
No, we have had some notable failures on that front. In fact, we've had about as many failures in terms of the pure play spin-offs as we have successes. Fin which was Chase's first attempt at, a digital banking app in the US failed. Bo failed. And, in both of those cases, it was really a cultural issue rather than a technology issue. The leadership team was divided in respect to their incumbent, presence in the market, the branches, the cannibalization of the business and so forth. And so with that, they weren't able to commit fully to that. Whereas if you look at DBS going into from Singapore into India, or you look at Chase in the UK, I think that's a different proposition because they don't have to, they're not competing with themselves in that market. And so it's a lot simpler.
Yeah, now that leads me on to a really good point in that we've seen obviously some failures. We've also seen some brilliant examples of positive ones around the world. So what are some of the issues that are coming out from that? Brett, you were just mentioning there, talking about moving into a different geography. Is it almost impossible, and Ruby, if I come to you for this question, for a speedboat bank, a digital pure play bank, to start in its home market and actually thrive? Or is it just waiting to be called off the line further down the line?
Yeah, Doug, I don't think it's impossible, right? I mean, it's certainly doable. There have also been some notable successes. Goldman Sachs, which we just alluded to, created Marcus in partnership with Apple, and they've been a brilliant success in the US. But I think a key again was they did actually go into a different kind of new market. So this wasn't investment banking, which is Goldman's traditional space. Yeah. This was going into retail banking, right? Very smart strategy. But even beyond that, I think I wouldn't want to say definitively that it's impossible for a speedboat to succeed in its home turf. I think it can be successful if the leadership has a very clear remit and very clear vision about what they're going to do. If they can define their product in very clear terms and differentiate themselves from the mothership and its capabilities, if they can articulate their value proposition in a very clear way, and they have the freedom to go ahead and execute, then I do think they can be successful. We just haven't seen a lot of examples lately.
Yeah. Now, with that in mind, then, we haven't seen that many examples. Brett, what are the opportunities that present the parent bank and the speedboat bank? Is this being driven by trying to accommodate new customer demands? What are the actual opportunities behind this?
Well, obviously, going to new markets is is the easiest opportunity, in respect to the fact that it allows for, creative expansion based on digital. But if you look at the success that digital pure play banks are having in the home markets of some of these large operators, the fintech challenger banks in the UK, Singapore, Hong Kong, and so forth, even in the US, you can't really make the argument that, a local player in those markets couldn't do the same thing. I think it really comes down to, culture. And as Matt said before, it's also about legacy infrastructure. The way to do this is you've got to really create a new organization structure on the side that doesn't have the constraints either from a policy or technology perspective. So one example of that in Australia was Ubank. Now, Ubank they recently acquired 86400, a fintech bank as well, to beef up their digital presence. This is, of course, the digital pure play arm for NAB in Australia. But they have had some complexities in the past. Ubank was launched in the midst of the financial crisis. It went on to become one of the largest deposit-taking organizations in the Australian market very rapidly. But Gerd Schenkler, who was the CEO at the time, made the mistake of going out in press and saying, hey, we raised more deposits than the branch network of NAB.
Oh, wow.
He was gone a month later. Right. And so at that point, then there was an effort to sort of try and absorb Ubank back into the existing, system and constrain it. And that sort of, led to a few years in the dark for Ubank, with sort of questionable strategy. And it took some time for them to really get comfortable with the fact that it needed to be a separate organization on the side, operating on its own merit. And so I don't, a lot of banks have a lot of nervousness about that, because what happens if this is more successful than the traditional bank? What do they do then? Do they then, have to try and get customers to move over? Do they have to, do they use that as a template for turning the whole ship? Do they absorb it back in and try and take the culture of the tech startup and infuse that into the mainstream bank? All of those are very difficult and tricky questions that we really don't know the answer to at this point. But if you want to do it in your home market, you've really got to let it be independent and not constrained by the politics and the policy and the technology of the incumbent setup.
It sounds like something the traditional banks would be able to do very easily, just to let that go. Now, with that in mind, if we are going to get to a point where banks are seeing this customer demand for better services, better technological services, better branding, better than the parent organization is currently providing, then surely isn't that maybe underlining that there's actually maybe an issue, but on the traditional banks? I know some of them are certainly trying to innovate and are hamstrung by legacy systems, but doesn't that scream that something needs to be changed if companies that are leading the industry are creating their own organizations to kill them?
I think that's the paradigm shift, right?
Yeah.
It is, the fastest growing FIs in the world are all digital. They're scaling rapidly. That means they're taking market share. If you look at the UK market now, about 38% of salaries are paid into challenger bank accounts, right? So that is a leading indicator of the fact that people's banking habits have changed fairly significantly.
Yeah.
So you really are seeing market share starting to change. We are starting, obviously, to see big valuations going for these tech-based banks, because tech-based banks tend to be valued or measured from a market perspective more like tech companies than they do traditional banks. And so that's changing market share, it's changing valuations, it's changing the way the industry thinks about the banking sector. So that's already a fact, that's already happened. So if you're in a traditional bank, you've got to be terrified right now. Is like, what is the future for our model if it's not, if we don't do what the digital players are doing? And that's really sort of the navel gazing moment that we see happening around the world.
Really interesting point. And if you consider, so I won't quote him directly, but Jamie Dimon's quote about how scared he is about digital and fintech, right? But what's interesting in this, and this is the challenge when anyone becomes an incumbent, and the neobanks and challenger banks at some point will become the incumbent. First you're the cool kid and you're super interested and you're changing things and you're disruptive, but eventually you become the incumbent. The problem with that is then your success breeds that you know what you're doing. And then suddenly, well, I know what I am. I'm a bank. This is what we do. But if the game has changed and the market has changed and the expectation has changed, then you're not. So with Jamie Dimon's announcement, he's scared, but then we're going to invest $12 billion in banking financial services and digitalizing it. But what ratio of that is actually just standard spend for tech for the bank anyway? If it's 12 billion extra on top of the existing technology stack spend, that's interesting. If really it's, well, there's only 100 million extra going into this in the next 5 years, not so much. So it's very easy. And that's often a big banking statement is, we're worried, we're concerned, let's just throw some really big, interesting numbers out there that appear to demonstrate we're taking this really seriously and we're on top of it, when actually it's not necessarily the case. And don't forget, if JP or Citi, etc., if they grow 10% year on year, as an example, that's huge amounts of money. That's monstrous bonuses that internal people are getting paid. So where is the desire to change? I already got my bonus. I'm already getting the things I want to achieve personally. So where's the will to risk it all to go digital? And actually the metrics, as Brett spoke about earlier, and Ruby as well, the metrics aren't the same when you move to customer outcome metrics, not bank outcome metrics. And that's where we're seeing the shift to contextual banking versus traditional banking.
Interesting. Yeah. Having that cultural change is often going to be the hardest part of this conversation, isn't it? How do you instill in a multinational corporation this willingness to kind of adapt while, as most institutions are made up of risk managers, and rightly so. So then I guess, Ruby, how do you, this is almost the hardest question of the day, I imagine, this is going to be the golden goose, how do you connect the digital pure play bank that is innovating at this speed and then bring it back into the original business, or at least take parts of what they've done and exemplify them in the old one?
Yeah, I think that bridging strategy is really hard to pull. And I think you either go full in and say, all right, we're going to build a speedboat, we're going to let it loose. If the current shareholders in the traditional bank will get a piece of the speedboat when it eventually has some kind of an IPO or when it gets spun off truly as its own entity. And that's how we'll unlock shareholder value. And it's okay if customers migrate from the traditional bank to the speedboat. I think bringing the speedboat back into the mothership is kind of difficult to do.
Yeah.
And I don't think we've seen an example of that happening as yet. I mean, I think with this paradigm shift that Brett just alluded to, customer behavior has changed. The platforms that customers use to manage their everyday lives have changed. The way that we do transactions, the way that we handle the financial chores in our life has changed. The way we shop has changed. The way we pay for things has changed. And so we really have to start thinking about financial services stepping up to the plate and meeting our new expectations, our new requirements. So specifically in terms of how do you bring the speedboat back to the mothership, I think you're probably better off on not doing that so much. And maybe all you do is bring back the lessons that you learn from the speedboat and then apply them to the mothership and try and convert that into a bigger speedboat at some point.
Interesting. Now, what I'm getting really from you guys in this conversation is that the consumer demand is there. I mean, the original question was, are these banks applying the technology without actually understanding their customer? What I'm starting to realize is actually the customer is already here. It's the institutions that are playing the catch up. And I think we've always known that by being within the fintech industry, but it's interesting that even we're starting to realize the institutions are fully aware of that now. But one thing that really excites me within the finance industry is obviously embedded finance. And the fact that it's actually finally becoming more of a reality. We're starting to get those use cases that people and institutions are putting forward. So Brett, are we going to see more finance companies within the next couple of years actually start offering up their financial products and services themselves? And are they going to be bundled by a traditional institution in the back end, or are they going to be completely run on their own?
Yes.
Perfect.
All of the above.
Was 2 years too long a kind of
No. So I think, if you look at some of the early embedded finance stuff that we're seeing, things like buy now, pay later, or embedded insurance offers and things like that, these are just the very early use cases. The way I describe it in Bank 4.0 is I talk about 3 core pieces of utility that banks provide, which is the ability to safely store money, so value stores, the ability to move money and make payments, so wires and making payments with wallets and cards and so forth, and access to credit. And so that's the core utility that sort of we are starting to play with in terms of real-time access that's wrapped in a certain, contextual scenario. So instead of selling a mortgage in the future, you'll be supporting a home buying experience. If you walk into a grocery store, your smart wallet will tell you, hey, you don't have enough cash to buy your groceries today. It won't tell you to sign up for a credit card on your mobile device. It'll just address that problem as you walk into the grocery store and give you options of how to do that. So this world of embedded finance, it does favor to some extent the technology layer that we'll be using for access to commerce and services in the future. And so that includes smart speakers, smart glasses, which we'll probably see Apple dip their toe into later this year. Facebook's already working on that Oculus and Meta are working on that with Project Aria. And of course, smartphones and the continued development of that, and smart vehicles and so forth. This is where embedded finance plays. Now, at some point, we have the very realistic challenge of how many partnerships does Apple want for their mobile wallet ecosystem? We've seen them starting to acquire capabilities for alternative credit scoring and things like that to be some sort of, part of the gatekeeping infrastructure for that. And I'm sure that they will want to charge banks and other players for access to their customers. But the real question is, who has the data to really create these embedded finance instances? It's like, there's geolocation triggers, there's behavioral triggers, things like that. So that's where it gets really interesting, because a lot of the incumbent banks don't have that sort of data. For example, they don't know your intent to buy a home. But it's safe to say that Google and Apple and Microsoft probably do, from your searching, behavior and other things. So they have to really partner with these sort of tech providers, these data layers, to be able to play in that game. So that definitely changes the influence or the power in respect to the gatekeeping process of getting access to that core utility of financial services moving forward.
I think there's an interesting part as well, that if you factor in trust in brand. So we're talking about banking currently, but you are either an iOS user to a point or an Android user, and you trust that brand to a point. But if we use Apple as the example, you trust Apple to give you entertainment, Apple Pay, what other capabilities, wearables, med tech. So you're in that ecosystem, which was always the idea. There were products that we all went, I like that product, I like that product. But actually the idea was to get you into the ecosystem and leverage it further and further. And this is where banking has an opportunity to reframe itself. And I'm going to use the example of, if you think about Tesla, I know, fanboys, non-fanboys, etc. Tesla is very, very Marmite as a subject. But the reality is, most people say Tesla is an electric car company. And actually, it's not. It's a transport company. That's how it sees itself. That happens to be electric. It just so happens that the product it transports currently are people. The idea with autonomous, etc., the truck, the extra vehicles, it'll move on and on and on. So they're a transport company. Banks have the ability to just become a financial digital lifestyle enabling company. And it may well be that they don't even offer all the services and capabilities, but through marketplaces, collaboration, either with a big tech or other entities, challenger banks, new insurance products that come through fintech, etc. They can own the customer's relationship, the data. Brett talked about value stores earlier with holding the cash, but then that data is enriched and enables you to offer in-time services to your customer base. So you can say, actually, this person is looking for a house based on geolocation things that they're doing at the moment, or the apps they're looking at, because we all know these apps are listening and they do measure what you're up to, and then things are offered. I was in a garden centre once, because that's the age I am. I happened to be talking to my wife about something I saw. That was it. When I got home and went on social media later, that product appeared in an advert trail. Right, so we know these things go on. So there is a real opportunity, if the banks are prepared to understand their position is changing, then they've got a real opportunity to capitalize and cannibalize themselves.
Yeah. If I can jump in, Doug, and add something, just building on that trust element that Matt spoke about. Banks have always prided themselves on the trust that their customers have in them, right? And rightfully so. But with embedded finance, what might happen is that the banks that hold the assets might actually be relegated to becoming more of a background player, and the organizations that are providing the services in which the financial elements are embedded, those organizations become more prominent in the customer's minds, because that's where the interaction is happening with the customer. And if you look at digital banks in particular, one of their strengths is communicating with customers through digital interactions. And so the ability to do nudges, or the ability to send push notifications and remind people, or give them insights in real time that are contextually relevant to where they are and what they're doing. All of those capabilities lead to that familiarity developing over time between the customer and the organization that's providing those digital interactions. And then eventually that familiarity morphs into trust, because this is an organization that I'm talking to on a regular basis. They're anticipating my needs, they're providing potential solutions. And if the traditional bank actually recedes further and further into the background, with their brand less and less visible, with people going into the branches less and less, those digital interactions really become important. And so that's an amazingly important phenomenon that's gradually underplay. And I think the leading banks recognize that and are trying to step up their digital game so that they can maintain that digital interaction and replace the physical interactions with the digital interactions. But it does, this whole movement towards embedded finance is something that the banks really have to wrap their minds around and say, well, how do we prevent ourselves from becoming relegated to be background players?
Yeah.
To Ruby's point, that's exactly what happened in the Chinese market with Alipay and Tencent WeChat Pay. The utility of those mobile wallets and proving themselves over time led to a shift in trust, where those organizations were more trusted than the traditional banks, because the utility factor was so high.
Yeah. Now, speaking of, for instance, in the Chinese market is driven, for instance, you can interact in a digital space, whether it be, over Weixin, or, interacting over QQ, or, for instance, in LOL. We're starting to see banks actually starting to look at how, again, going back to Ruby's point, interacting in this digital ecosystem, but not in a kind of just connecting companies, connecting with their consumers in a digital ecosystem. And I think the metaverse, we're starting to see some of the traditional institutions really starting to embrace it. I think, I think it was JP Morgan, for instance, instigated a kind of digital branch in the metaverse. We're going to start seeing that go forward. And I'm going to open it up to the floor actually to see if anyone's got any perspective on this, because it is so unusual that we're starting to see this. It is the final frontier of the digital space. So, I mean, how is that going to enable the banks? And is there, going back to the first question at the start of the conversation, is the customer demand there for it yet?
Well, the customer demand, not necessarily, but we can see on the horizon the potential for Web3, particularly the metaverse. The really interesting piece of this, though, is the way we think about banking and payments and property and digital assets. So we've got NFTs, we've got real estate now being sold in Decentraland and other parts of the metaverse, which, as you said, JP Morgan has gone in and put a branch in there, but that's just like Second Life stuff. The really impactful piece of this is that if you are working or living in the metaverse, you're going to have to transact. You're not going to pull out a plastic card and swipe it in a virtual point of sale. That's not going to happen. So you're going to use a wallet. And you're going to use that cloud-based wallet will enable you to earn tokens or cryptocurrencies. It'll enable you to use stable coins, CBDCs in the metaverse, all of those things. But the cloud-based wallet will be the bridge between physical world and the digital world of the metaverse. No banks have gone down that route as yet, and so that's really where the gap is right now. Is if you think about what's happened with fintech, that's going to replicate itself with a whole bunch of new businesses that will start in the metaverse around digital decentralized finance that it has a metaverse flavor to it. And so, we talk about the fintech explosion over the last few years. The metaverse is going to see all of sort of the e-commerce and, working capabilities and working platforms and creating businesses in the metaverse. This is a whole new area that is yet to really explode. So, it's early days, but putting a bank branch in Decentraland, this is not a bank being ready for the metaverse, I'm afraid.
Okay, yeah, it's using 20th century problems for a 21st century solution. I mean, another interesting thing is obviously I'm bringing up the video game experience again. I don't know why, I don't even play them, but video games have different currencies on a different video game. If you have a digital wallet that operates in a metaverse that has your currency in each video game in one place, you're going to start transacting a lot easier, and parents are going to lose their hair even quicker. It's going to be a very interesting play. But finding that sweet spot to create that delightful customer experience in a digital world, I think, is where the banks are going to really struggle, because, as you said, they're putting in bank branches in a digital experience. And is that really?
Well, think of it more like the whole influencer space, so TikTok, Instagram influencers and things like that. These are, creators that have now generated huge income streams from these virtual platforms. That's the best way to illustrate the way creators and people working in the metaverse will be able to create value. But they may be paid, as you said, in cryptocurrencies and other things like that. So do banks have crypto custody? Is that linked? Do they have an ability to have a wallet that can plug into the metaverse that allows trading in alternative currencies like cryptocurrencies? NYDIG has done some partnerships with banks in the US and the EU now, but that's very early stages. But still, there's a massive gap. If you think about all these new jobs and types of businesses that could be created in the metaverse, and the fact that financial transactions will have to be sort of the lifeblood of that, you'd think that banks would be investing a lot more in that sort of core wallet infrastructure than they are today.
Yeah, sorry, Ruby, go ahead.
I was going to say the wallet is really an interesting focus point. And if you look at who is investing in wallets right now, it's actually the platform players like Apple and Android. Apple's done so much with their wallet. You can store not just credit cards and debit cards, but you can store, in the US, I can put my health insurance card, I can put my driver's license if I'm in Arizona, and they're rolling that out gradually to the other states. I can put loyalty cards, hotel and airline loyalty cards. I can put tickets to events and even train tickets and plane tickets. So there's all kinds of stuff I can put in there. So they're really developing an ecosystem around the wallet, and having multiple currencies and having crypto in there will be a logical extension. They probably won't do it in classic Apple fashion until the market begins to develop and there's more of a need than there is today. But you can easily see that they're doing much more to make their wallet central to people's lives than any of the banks are in a position to do, frankly.
Yeah. The banks really do see it just as a financial issue, when obviously Apple is seeing it as a lifestyle thing. Sorry, Matt, please continue.
So we've seen in the last couple of days, MasterCard have actually listed trademarks in the metaverse as well to ensure that they are, they're a trusted brand, whether you use them or not. So it's another brand association that Ruby was referring to earlier, where that must be safe as an idea. But I think if we can take back learnings from web, when the original web was launched, most people thought, well, why am I going to, I'll use Amazon because it's the biggest one, right? Why am I going to buy my books online? I go to the store to do this. We're talking about behavioral change fundamentally. And that's the big bet that the big techs are taking, is that society is going to shift and evolve in this direction. Banks aren't necessarily looking at it in this way, because we talked earlier about the incumbency behavior. If I'm a bank, banking is banking. This is what I do. But it's always been the case of the bank needs to be wherever the customer is at whatever stage they're in their journey. And that may be 3 different points in one day. So that's where it's so important that you've got to understand who your customer is in a traditional sense, what it is they're looking to achieve, and are you able to supplement that? And be brutally honest and say, if I can't do this, who do I need to partner with or collaborate with to ensure I can still offer that service. And that's still a mindset change. We've seen HSBC have announced they're going to invest in fintech partnerships, because I think HSBC Net app was had 125% increase in downloads so far this year. So they're on the commercial side. So they're suddenly saying, actually, we need to do this. But again, it's very easy to throw lots of money. And I think that's the thing we see with fintechs when they explode. We all get caught up in so-and-so has raised 100 million or 500 million and is valued at X, Y, and Z. But there comes a so what moment, as in, what does that mean for the end consumer? And this is why we see some fintechs, flare really tremendously, burn out quick and disappear, which is another reason why the banks say, but we're a bank. They come, they go, but we're still here. But I think over the next 5 years, I think it's realistic that the things Brett's discussed, Ruby's discussed as well, we are going to see this shift into what service can you offer me where I am, and if you can't, I trust this device, not a banking brand, and that device gives me access to competitors, and I will use that whether you're there or not.
I refer to this period of time, Matt, that you're talking about as the smart wallet wars or the smart bank account wars. Is that as fintechs and the tech giants start to compete with embedded finance offers saying, we have a smarter app or a smarter ecosystem that can decide what or provide for your financial needs on an anticipatory basis better than a dumb bank account that doesn't give you any information, right? So, banks who are still issuing debit cards in 2025 and don't have a vehicle for this embedded finance intelligence with the financial wellness piece and the alternative credit scoring and alternative credit access and things like that, they're going to find it increasingly difficult to differentiate, because all of the emphasis that the alternative players will be bringing to the table will be things that aren't related to bank products and services. It's more about you managing your financial health, your financial wellness, giving you access to credit when and where you need it, helping you achieve the things in life that you want to achieve. This is not the type of language banks can really defend on the basis of their current product set.
I think we're starting to see, as maybe in the late 90s, early noughties, the technology embedded itself in every vertical, every industry, and segmented it into every part of our lives. And to what you were saying as well, Matt, we're starting to, and you too, Brett, as well, we're starting to see every financial transaction, you have to be with the customer at every part of their day, because the volume of transactions is increasing. You're having to spend money wherever you want, whenever you want, at a rapid pace. And if the banks can't seize that opportunity, they'll die out. But guys, we've come to time. I just want to say a massive thank you. I think we could have gone on for probably at least another half an hour just discussing the future, but it's been an absolute pleasure hearing all your insights, because this is really where, if Web 3.0 is kicking off, Brett, to your book series, the fintech dots are coming along. So guys, thank you very much. And also a massive thank you as well to our viewers. You can catch the rest of the series and much more over on YouTube, and of course, LinkedIn, where you'll see me in the comments, and definitely over at ffnews.com. Guys, once again, have a lovely rest of your days. It's been great speaking with you, and goodbye.
Thank you. Bye-bye.
Thank
you.